If you look at the addressable market for what it takes place on the banking system and just assume that half of this ends up on the blockchain, then that's really worth $3.8 trillion of captured value on Ethereum. And then if you think about like Swift and Visa, okay, which is about 450 billion a year, and assume, there's a gas fee per transaction, and then what it means to essentially network revenue. And you apply, I think, a conservative 30 multiple to that, you get roughly 3 trillion of value. So the idea is that if you add those two pieces together, Ethereum should be close to $60,000.
Ethereum has long been seen as the second choice in crypto, powerful technology, yes, but always in Bitcoin's shadow. Yet Fundstrat's Tom Lee is challenging that perception. His analysis suggests Ethereum's role in the global financial system could be far larger than most investors realize. If blockchain is the new financial infrastructure, then Ethereum is rapidly becoming the settlement layer everything else plugs into. Lee projects a potential $60,000 valuation per Ethereum within the next 5 years. At the heart of his argument is Ethereum's role in the financial system of the future. Lee draws parallels to Visa, Swift, and traditional banking, estimating the value Ethereum could capture from payments, settlement, and tokenized assets. Even if just half of traditional banking transactions migrate to blockchain, Ethereum's addressable market would skyrocket into the trillions. Add global payment systems and a conservative revenue multiple, and today's Ethereum prices look almost negligible. Lee also sees Ethereum's current moment as historically significant. He compares it to wireless technology in the early 1990s, dismissed as experimental, misunderstood by incumbents, but on the brink of exponential adoption. With Ethereum poised to become Wall Street's preferred settlement layer, the upside could be staggering. Beyond price targets, Lee highlights a once-in-a-generation window for institutional adoption, regulatory clarity, and real-world use cases. In this video, we'll break down his key insights, including why 2025 could be Ethereum's 1971 moment, what it means for investors, and how new models like crypto treasuries could reshape exposure to Ethereum. Cybercriminals are getting smarter, and everyday investors are the new target. You worked hard for your crypto. Don't lose it to a scam. Recently, attackers bribed offshore agents at major crypto platforms, stealing names, birth dates, even social security numbers. They drained real accounts in seconds. No blockchain hack, just human error. Once it's gone in crypto, it's gone. That's why ITrust Capital created the Premium Custody Account, the most secure way to protect your asset. It's a closed-loop system, meaning funds can only move between you and your account. Even if someone gained access, they can't steal your crypto. Backed by institutional-grade custody at no extra cost. Sleep easy knowing your investments are locked down. Click the link, use code DOSE7, and get a $100 funding bonus. Start protecting your future with ITrust Capital.
I've essentially had one job my entire career, which is researching markets. And I first started off at Kidder Peabody, following the technology sector, wireless actually, and that went from 1993 to 2007. What I learned during those days was a few things. The wireless industry was in its infancy. There were only 37 million cell phones in the world at the time. Today, there's around 8 billion, so it's an industry that grew exponentially. But I was surprised at how skeptical clients were about wireless as a technology, because at the time, long distance and local telephones were really the big business of the telecom industry, and wireless was considered basically something that would become free because it's just a glorified cordless phone. So I knew as a young person that a portfolio manager in their 40s is not the person that really understands disruption in technology, because they're essentially an incumbent. And then, I became chief strategist for JP Morgan, did that until 2014 before starting Fundstrat. And at the time, Fundstrat was created to be what I would consider the first Wall Street firm to try to democratize institutional research. We wanted to make what we were doing for hedge funds and large managers available to the public. And then around 2017 or so, I started to see headlines that Bitcoin had crossed $1,000. And I remembered many conversations at JP Morgan about Bitcoin from our FX team. And at the time, it was under 100. And we had many conversations because there was this idea that this digital currency could become recognized as a form of money. But at JP Morgan, they took a very dim view of it because they said it was really the purview of drug dealers and, smugglers. But I know that in my 20-year career, at the time, 20 years, that I've never seen anything go from under 100 to 1,000 and have a network value of 10 billion. That wasn't something I had to study. So we studied it, and I realized that while I didn't fully understand how to justify storing value on a blockchain with proof of work, that we could explain more than 90% of the rise of Bitcoin from 2010 to 2017 by just looking at two variables: number of wallets and activity per wallet. And because of that, we could model what Bitcoin could look like in the future. So that was my first, journey. And so we published our first white paper when Bitcoin was under 1,000. And we said that if someone viewed us as a substitute for gold and it got only a 5% share at the time, you would get to $25,000 value for Bitcoin. And so that was our projection by 2022. And by the time 2022 came around, of course, Bitcoin was around 25,000.
You're doing some interesting stuff with Ethereum. Can we talk about the macro opportunity for Ethereum?
So for much of the work, and Sean and David, you guys know that from 2017 up until 2025, our focus on crypto has been the idea that, Bitcoin had a very clear place in someone's portfolio because of its not only proven size and stability, but it really is as a way to store value. And then when we thought about how people should allocate crypto outside of that, there were many projects, whether it was Solana, Sui, or the many things that you guys write about. But beginning this year, we started to take another hard look at Ethereum. And the reason for that is that I think that the regulatory picture is moving in a way this year in the United States in a favorable way that is getting Wall Street to take crypto and blockchain pretty seriously. And of course, the killer app or the ChatGPT moment really was stablecoins and Circle's IPO. But following on that was the Genius Act and then the SEC's Project Crypto. And the reason I think this favors Ethereum is many, but foremost, when we look at the projects that are taking place for Wall Street to tokenize assets, whether it's dollars or other assets, the majority of this is taking place on Ethereum. But maybe more importantly, I think, people have to take a step back and realize that what's happening on Wall Street in 2025 it's maybe more akin to what happened in 1971. And in 1971 was the year the US dollar depegged from gold. So the US went off the gold standard. And while gold was a beneficiary of that, many people bought gold, it was actually the idea that Wall Street began to innovate because suddenly you had a fiat dollar that you now had to sort of move around and create rails for that was not backed by gold. So the real winner there was Wall Street. Well, in 2025, this kind of innovation, blockchain solves a lot of problems and speeds a lot of things. Wall Street moving onto crypto rails, I think, is like a 1971 moment for Ethereum. So I think it's creating enormous opportunities to move a lot of things onto the blockchain. And Ethereum won't be just the only winner, but it's one of the primary winners. And from an institutional adoption perspective, I've heard a lot of people talk about this. Bitcoin's already become very institutional. When I talk to investors and I do meetings, they understand how to sort of understand how to model or even think about future value for Bitcoin. And it is in a lot of people's portfolios. Ethereum is so underowned that it's more like Bitcoin in 2017. I don't think Ethereum is actually viewed as an institutional asset today. So I think it's so early, and that's why I think there's a bigger opportunity.
Tom Lee's credibility comes from decades of spotting disruptive technology early. In the 1990s, he watched wireless technology evolve from a niche cordless phone upgrade into a global necessity with billions of users. The incumbents dismissed it, but exponential adoption proved unstoppable. He saw a similar pattern with Bitcoin, which surged from under $100 in its early days to nearly $69,000 in just 12 years. By analyzing key variables like wallet growth and transaction activity, Lee developed models that consistently explained Bitcoin's trajectory and long-term value. Now, he sees Ethereum entering the same kind of exponential curve. For Lee, 2025 could be to Ethereum what 1971 was to Wall Street, the start of a structural reset. Stablecoins, tokenized assets, and enterprise blockchain adoption are the catalysts, and Ethereum serves as the settlement layer tying it all together. While Bitcoin has matured into an accepted store of value, Ethereum remains underowned, underappreciated, and institutionally underallocated. Lee argues this disconnect represents one of the largest asymmetric investment opportunities in the market today. His most striking forecast? Ethereum could reach $60,000 within 5 years.
You have a price target for ETH, which I might just have you explain how you get to that. I think it's 60,000.
I'm citing work when we did that analysis for ETH. It was some research done by Mosaics and some other folks. And what they wanted to do was, again, approach it as if this is a 1971 moment. And so they wanted to think about the value of Ethereum as both a payment rails and then capturing a portion of payment volumes. And so I think both are kind of additive concepts. And so their idea is that if you look at the addressable market for what it takes place on the banking system and just assume that half of this ends up on the blockchain, then that's really worth $3.8 trillion of captured value on Ethereum. And then if you think about like Swift and Visa, okay, which is about $450 billion a year, and assume, there's a gas fee per transaction, and then what it means to essentially network revenue. You apply, I think, a conservative 30 multiple to that, you get roughly $3 trillion of value. So the idea is that if you add those two pieces together, Ethereum should be close to $60,000 per unit. And again, that's that's an 18x roughly from here.
How should the audience go about thinking about the trade-offs of exposure, between treasury companies and other options like spot or ETFs, just broadly?
One, there's nothing wrong with someone wanting to own an ETF to get exposure, because then they're going to own, without much tracking error, kind of direct exposure to Ethereum, just like the Bitcoin ETFs give you direct exposure to Bitcoin. But if you look at the Bitcoin treasury space, MicroStrategy is larger than the largest Bitcoin ETF. So there's actually more investors who are preferring to own Bitcoin through MicroStrategy than through Bitcoin. And I think it's for a logical reason, which is that a crypto treasury isn't just giving you a static exposure to Ethereum. What they're doing is they are giving you exposure to someone who is trying to grow your Ethereum holdings per share. And MicroStrategy is a great example. When they went to pivot to their Bitcoin strategy in August 2020, MicroStrategy had roughly a $13 stock price, and it's gone to 400, well, let's say 30x from that point in the last 5 years. During that time, Bitcoin was 11,000, and now it's about 120,000. So it's about an 11x. That means that MicroStrategy has grown its holdings of Bitcoin per share, while like a Bitcoin ETF would have kept you constant. So in that same 5-year period, you'd made 11x owning a Bitcoin ETF, but you did far better because of his treasury strategy. And that treasury strategy is using and taking advantage of the liquidity of his stock and the volatility of his stock so that he can acquire more Bitcoin per share. And that's what Michael Saylor's strategy has successfully done, because he went from having, $1 or $2 of Bitcoin per share to 227 today. So a massive, massive increase. The majority of the time, someone's coming and looking at crypto treasuries with a really skeptical eye. I think many investors who've owned MicroStrategy have done really well with it, but MicroStrategy is not as widely owned as you think, even though it is one of the largest stocks in the market today. And the reason many people don't understand it is that we already have a very big universe of people that don't believe in crypto. I mean, whether you look at any survey, the Bank of America's latest survey, 75% of institutional investors have zero exposure to crypto. Zero. So that's 3/4 of the universe. And when they look at crypto treasuries, they think that these are inferior to holding the underlying token. And so a lot of the education that we've done in our meetings is to explain that, and I can just cite some numbers from BitMine's presentation. The difference in a crypto treasury versus holding Ethereum is simply the fact that we are growing your Ethereum holdings per share, because on July 8th, when we closed the pivot to the Ethereum treasury, there was only $4 of Ethereum held per share. And then on July 27th, which is about a month ago, when we published that update and put it in a presentation, there was $23 of Ethereum per share. So the amount of ETH held per share went up by like 6 times, and 8 times, 9 times. And so it really shows you that there is a really big change in how much, what I call the velocity or the accretion held of ETH per share that comes from a properly executed treasury strategy.
The strength of Tom Lee's analysis lies in how he builds his forecast. Rather than relying on speculation, he evaluates Ethereum like a traditional equity analyst would assess a disruptive tech company. First, consider the banking sector. Trillions in settlement value could migrate to blockchain. Even a 50% capture rate for Ethereum puts it in multi-trillion-dollar territory. Layer in global payment systems like Visa, MasterCard, and SWIFT, and even with conservative multiples, Ethereum's valuation easily supports a 5-figure price tag. What makes this outlook compelling is the convergence of macro trends and institutional behavior. Regulatory clarity is improving, legitimizing stablecoins and on-chain settlement. Wall Street firms that once dismissed crypto are now piloting tokenization projects, mostly on Ethereum. Unlike Bitcoin, which already enjoys deep institutional penetration, Ethereum remains largely underowned, with surveys showing 75% of institutions still holding zero crypto exposure. This gap represents enormous growth potential. Lee also highlights the rise of crypto-native treasuries, companies that actively compound Ethereum through staking, yield, and market strategies, rather than passively holding it. Much like MicroStrategy's aggressive Bitcoin strategy, Ethereum treasuries could multiply holdings per share, creating leveraged exposure to Ethereum's growth. Taken together, Ethereum is no longer just the number 2 crypto. It's positioning itself as the financial infrastructure of the future, with potential to scale into a multi-trillion-dollar asset. If Lee's framework is even partially correct, today's prices will look laughably cheap in hindsight. For long-term investors, the next 5 years could be the most consequential window to build exposure before institutions flood in. So, what do you think? Can Ethereum truly become the backbone of the global financial system and hit $60,000 by the end of the decade? Let us know in the comments. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.